Facebook. Initially started by Mark Zuckerberg in his dorm room in Harvard, Facebook has completely changed the way that we communicate. Today, I am discussing Facebook's price and possible price movement. I am looking at its business operations, its fundamentals, and its valuation compared to its rivals. If you are interested in videos like these, subscribe down below and please like this video to help grow the channel. It really does help a lot. Alright, without further ado, let's get started. Right now, Facebook trades for about $329. Its latest support is between $296 and $300, and its latest resistance is actually around $330. So essentially the price that it is trading for right now. This is a crucial moment. If it manages to break $330, then we can see an upward movement going up to $360, which is the high ceiling of this channel that it has started to form. If you haven't invested yet, it could be a good time to wait for a couple of days or a week to see how the price will evolve. I have a feeling that it will start consolidating, or it could slowly drop down to $315 or, worst case scenario, $300. It is currently trading above its 50-day moving average and its relative strength index is near the top, but the volume is relatively low, which makes me think that we probably will not see a lot of movement in the next week or two. However, as I said, I think that there is a good chance that we can see Facebook hitting $360 in a few months and maybe even $400 by the end of the year. Why? Well, Facebook has been delivering great results after great results. The fundamental performance of the company has been amazing so far, absolutely amazing. In fact, out of all of its 20 earnings reports since 2016, it has only missed one, and that was by 1 cent, and it has only missed revenues twice. The company outperforms analyst expectations, and by a big margin, especially in the last 4 quarters. Last quarter, it beat analyst earnings estimates by 41%. This is massive, especially for a company of Facebook's size. Essentially, what we're seeing is the pandemic boost in advertising that Facebook received was not as transitory as analysts expected. Also, there has been nothing but upward revisions for Facebook's full year 2021 earnings, which is a very good sign. 39 upward revisions in total. There have also been 23 upward revisions for the next quarter's earnings, which is almost always a good sign. Also, out of the 51 analysts covering Facebook in May, 45 have had a buy or a strong buy rating. However, let's leave analyst opinions aside for the moment. They're good to gauge Wall Street's appetite for the company, but let's look at the business, at the fundamentals. Is Facebook really a good company? First, we need to look at how Facebook makes its money. Its business can be boiled down to one word: advertisements. Facebook allows advertisers to use its products to place ads. By collecting data on users and their behavior, Facebook is able to offer targeted ads, which are obviously more expensive, but are also more attractive to advertisers. Even though regulators have reduced the amount of data that Facebook can gather, and therefore reduced its ability to target specific audiences through its ads, the company has still managed to grow its advertising business by a lot. Facebook owns 4 major products: the Facebook app and website, Instagram, WhatsApp, and Messenger. Another reason why the company has done so well is because it operates the 7th most visited website in the world, Facebook, which is also the 2nd most visited social media website behind YouTube. Instagram is extremely popular as well, ranking in the 23rd place. In terms of mobile users, out of the 6 most popular apps in 2020, 4 were Facebook's, with just over 2 billion downloads in total. As of the latest quarter, the daily active users of Facebook's family of products are 2.72 billion, with the number of monthly active users being 3.45 billion, or more than 10 times the population of the US. This is literally half of the world's population. Facebook is still seeing growth in user numbers, with its total base up 15% year on year, which is actually faster than last year's increase of 11%. So, we can see that their user base is growing, but is that translating into higher revenues? The answer? Yes. In 2020, Facebook reported a 20% year-on-year advertising revenue increase, but in their last quarter alone, the advertising revenue jumped 46% compared to last year. Advertising makes about 98% of Facebook's revenue, so we can see that the company is getting a serious boost in overall profits. Their net income also grew by 58% in 2020 year on year and an astonishing 94% in the first quarter of 2021 as compared to last year, essentially doubling. Basically, we can see that Facebook is reporting some serious growth for a mega cap company, and it is largely due to the increase in their advertising business. However, Facebook is also involved in virtual reality and augmented reality through their reality labs. While this side of Facebook is still tiny, it is reporting a serious growth in revenues as well. In the first quarter of 2021, its revenue grew by almost 150% as compared to last year, and now makes up 2.7% of Facebook's revenue. VR and AR are still relatively young industries, but they are growing fast. Market researchers claim that the industry will grow at an annual rate of 42% from 37 billion in 2019 to an astonishing 1.27 trillion in 2030. Facebook is one of the leaders in this space, along with Apple, Microsoft and Samsung, so this represents a massive opportunity for the tech giant and yet another solid bullish argument for Facebook. Unlike its competitors, Facebook's business is relatively concentrated, so I think that this gives the company a competitive advantage when it comes to growing its VR and AR business. The company has also grown its headcount by 30% in 2020, so we can see that it is doubling down on expansion and growth. Despite that, analysts are only expecting a revenue and earnings growth of about 15% annually for the next 3 years. To some extent, that is justified as Facebook did get a big bump in earnings due to COVID. However, I think that their estimates lean towards the conservative side, and I think that Facebook can actually achieve a growth of between 20 or 25%, especially when we consider the VR and AR business. And this may sound optimistic, but given Facebook's record of beating analyst estimates, I am okay with sounding optimistic. The only hurdle that Facebook may run into is regulation, which is always on the table for big tech companies like it. However, it has a good record of successfully dealing with regulation and delivering good results despite of it, so I will take my chances. Now, you may be thinking, great, Facebook is positioned well for the future, but how are the fundamentals looking right now? We can see that they are growing, but can they support that growth? Personally, I think so. Facebook has a tremendous balance sheet and a massive stockpile of cash and cash equivalents. The company currently has just over 64 billion cash and cash equivalents as of 31st of March 2021, which represents an increase of about 2.5 billion since the end of December 2020 and an increase of almost 10 billion since December 2019. The huge cash position means that Facebook has enough capital to expand without being worried about financing. It means that it can buy new companies to help its expansion or to prevent competition. But most importantly, it means that the company is doing well. We can also see that in the company's share repurchase program. Facebook has repurchased $6.3 billion worth of shares in 2020 and $4.2 billion worth of shares in 2019. In January 2021, it authorized an additional $25 billion worth of stock repurchases, so the total right now is just about $34 billion. This doesn't mean that they will repurchase all $34 billion, but that they can. Still, the fact that they have authorized that program is a positive sign. Also, in addition to their massive stockpile of cash, Facebook only has liabilities of $30 billion, or less than half the size of its cash stockpile. What does that mean? Well, it means that Facebook is healthy and is taking its vitamins. The company is solid and is more than able to tackle any short or medium-term challenges to its business. It has no long-term debt, meaning that if they do decide to borrow money, they will be able to do so at much better rates than some of its rivals. Now, let's have a look at some of the fundamental ratios of Facebook. What can we see? Well, we can see that Facebook is an absolute beast. The company's return on assets is 20.3% compared to the industry's average of 10.3%, and their return on equity was 25.3% last year. A return on equity ratio of 12% is a lot, but 25%? That is extremely high. Let's look at the context though. How do Facebook's rivals perform? Personally, I think that the companies closest to Facebook in terms of business are Twitter, Google, and Snapchat. Although, I must admit that Snapchat is in its very early stages of growth. In terms of ROA and ROE, both Snapchat and Twitter are negative, so there's not much point in comparing them. On the other hand, Google has a 15.3% ROA, which is 5% lower than Facebook's, and Google's ROE is also lower at 22.3% as opposed to Facebook's 25.3%. And I have to point out that actually both companies are showing really strong performance, although Facebook is a bit more efficient than Google in terms of generating returns. We can also see that in their margins. Facebook has a net margin of 35.7%, while Google has a net margin of 26.1%, both of which are very, very high. Then, in terms of health, we just saw that Facebook has no long-term debt, and neither does Google. But Twitter and Snapchat do have a fair amount of debt, which is a bit worrying given their lack of earnings, and just shows us that Facebook is running a very efficient business model. Now, let's look at pricing ratios. Facebook's forward price to earnings ratio is only 21.6, whereas Google has 25.5, Twitter has 52.4, and Snapchat has a forward PE of 92. So again, Facebook turns out to be the best price for its projected earnings. In terms of current PE, Facebook has 28.2, Google has 32.2, and Snapchat and Twitter don't have a PE because they're unprofitable. The current S&P average PE is 37.2, so we can see that both Facebook and Google are under the market average, although Facebook is, again, cheaper. What these ratios tell us is that Facebook is not only operating a very efficient business, but it's also at a very good price relative to its peers. Even if we look at the historical perspective, Facebook has rarely dropped below a PE of 27 or 28, so the current price is, again, excellent and cheap. This is my personal opinion, and please do your own research. But according to my EPS growth model, we can expect a roughly 12% annual return on Facebook over the next 10 years given its current price of $330. That is assuming a 15% earnings growth next year, which will taper off, and assuming that we can sell it at a PE ratio of around 30 to 32. If the earnings grow at around 20% next year instead, then we can be looking at a roughly 15% annual return, which is higher than the average return of the S&P 500, meaning that Facebook is likely to beat the market, at least in my opinion. Overall, Facebook is looking like a solid buy to me, especially at the current price, which is why it is actually one of my biggest holdings right now. One of the other companies that is likely to beat the market is Alibaba. The company is at a great price right now and has been doing extremely well, although there is a political risk there. Check out my analysis on it here, and also take a look at my 2021 stock picks playlist. If you've enjoyed the video, make sure you like, subscribe and share with anyone interested. Apart from that, thanks for watching and I'll see you in the next video.